Good afternoon and welcome to the LPEA webinar on DAC6. This EU directive focusing on the mandatory automatic exchange of information in the field of taxation in relation to reportable cross-border arrangements, what a long name, was also voted in Luxembourg and will be applicable soon. Our distinguished panel will give you more details on its scope, its purpose, and the concerns and entities. Some concepts like the hallmarks, subject or not to the main benefit test, over-under reporting issues will also be tackled next to concrete case studies. As usual, if you have questions, please use the Q&A button or the chat function. Giuliano, the co-chair of our active tax committee, will be today's moderator and guide you with his panel through the DAC6 subject. Giuliano, the floor is yours.
Thank you, Stephane. First of all, good afternoon, everyone. And thank you for attending this webinar on DAC6, Don't Be Caught Out. So my name is Giuliano and I'm working at BC Partners in Luxembourg. And I'm really have the pleasure to moderate this panel. Before entering and discussing about more detail about DAC6, let me introduce my panelists who will share today their knowledge and experience on these matters. First of all, Aurélin Budzin-Dang, which is a knowledge management department at Elvinger and Prussen. We have Olivier Farra, who is counsel at Baker McKenzie. Hoor, who is partner at ATOZ. And last but not least, Neugebauer, who is partner at Arendt and Medernach. Aurélin, just in order to set the scene, could you please give us a background of this mandatory disclosure rule?
Yeah, sure. Thank you, Giuliano. Well, you know, the international tax landscape has evolved at an increasing pace in the last few years, in no small part driven by the OECD BEPS project that seeks to counter tax avoidance at an international level. And one of the best way to achieve this big project is to increase tax transparency. And this is why the OECD calls on express actions in relation to information reporting to the tax authorities on aggressive tax planning schemes at an early stage. This would enable governments to quickly respond to the tax risk through assessment, audits, changes to the law or regulation. So responding to BEPS action on tax transparency, the governments, the European Union enacted in 2018, so 2 years ago, a directive, the so-called DAC6, under which member states are obliged to introduce by 1st July this year a new mandatory disclosure regime. But you know, the exchange of information is not something new. Such mechanisms have been in place in the European Union since the late 70s, with the big milestone being the enactment of DAC1 in 2013, which extended the administrative cooperation between member states and made the automatic exchange of certain type of information mandatory. Further, DAC1 has been amended several times, 5 times in all, each time extended further the tax transparency until the last amendment being DAC6.
And based on that and on your experience, what will have the impact of these mandatory disclosure rules for PE and area houses?
Well, the new mandatory disclosure regime will imposes on certain person the obligation to disclose information on certain type of transactions to the tax authorities in a timely manner. Those transactions are arrangements that display features characteristics of aggressive tax planning. Those characteristics, those hallmarks, to use the term of the law, are predefined by the law. They are exhaustively listed in the law. So each time a transaction, an arrangement includes one of these hallmarks, this would trigger the reporting to the tax authorities. I will add 2 points regarding the material scope of the law. The first one is that it applies only to cross-border transactions, meaning that purely domestic transactions that have no tax impact in another jurisdiction are not the target of the law. The second point is that it covers only direct taxes, exclusive of VAT or duties. Regarding the person that must report, intermediaries are primarily concerned. The intermediaries are the person that design, implement, promote the reportable arrangement. They are also the person that provide assistance in relation to the promoting, the designing of such arrangement. Where there is no intermediaries that are required to report, then the obligation to report is shifted to the taxpayer. This could be the case if, for example, the taxpayer has designed the Kimin house, or if all intermediaries involved are exempt from the reporting obligation. Because they could assert a legal professional privilege. In Luxembourg, lawyers, chartered accountants, auditors are exempt from the reporting obligation because they are bound by their professional secrecy. But even in this case, they have the obligation to provide assistance to the taxpayer to fulfill its own reporting obligation by providing him with all relevant information he needs. Regarding the information to be reported to the tax authorities, it is remarkable to note that it covers a wide array of data. It includes the identification of the taxpayers, of the intermediaries, of the member states involved, of all the persons that could be affected by the arrangement. It also includes a description of the arrangement, of the hallmarks that make that the arrangement reportable, the value of the arrangement, and so on. Once this information is reported to the tax authorities, it will be exchanged between tax authorities of all member states. Regarding the timing of the new mandatory disclosure rules, they will go fully live on 1st July this year, but will be backdated to include transactions which first step of the implementation is taken after 25 June 2018. Intermediaries and taxpayers will have in general 30 days to file their report. These 30 days will start as from the day after the arrangement has been made available for implementation or is ready for implementation, or the first step of the implementation is taken. For the intermediaries who only assist in the designing of the arrangement, the 30 days will start as from the day they provide such assistance. Regarding the transactions, the historic transactions, meaning the transactions that which first step of the implementation has been taken after 25 June to 2018, they must be reported before 1st August this year, 31 August this year, sorry. But a few weeks ago, the European Commission has proposed to defer the deadline for filings by 3 months, which means that the first reporting will be made on 1st October this year instead of 1st July, and for historic transaction, they have to be reported before 30 November this year. So this is basically the big picture of the new mandatory disclosure rule, but of course there's a lot of gray areas, especially due to the broad concepts that are used in the law, and it raises complex technical and procedural issues. So private equity and real estate players must for sure dedicate additional time and resource to be in compliance with DAC6, as the passing of data to the Luxembourg tax authorities can unsurprisingly be a sensitive issue for investors.
Thank you, Aurélie, for really setting the scene and really support people working in the alternative investment world to have more people to manage this DAC6. Olivier, Aurélie mentioned the various hallmarks that are defined in the directive form. Would it be possible that you give a brief description of the different hallmarks, and based what you see, what kind of structured transaction would be subject to reporting?
Sure, Giuliano, thanks. So the hallmark is a characteristic or feature that presents a sign of aggressive tax planning. What the EU Commission has done is that they have nailed down situation for which they estimate that a mandatory report should be made. So these hallmarks, they are all the same in all member states. So this is a one-size-fits-all approach, whereby all the hallmarks will be applied after an identical wording in all member states. There is an important point, though, is that even if the wording is the same, there can be divergences in their interpretation in each member state because of local guidances or because of local interpretation from the tax authorities. That being said, there are 5 families of hallmarks, so you have A, B, C, D, E. They are divided in 18 subfamilies, and as you see in the slide, some of them need what we call the main benefit test. Others don't need the main benefit test. This is really important. Hallmarks, the Commission has put forward an approach that they call the approach by the hallmarks, is when a hallmark is met, reporting needs to be done. If the hallmark is not met, then there is no need to report. So there is no interpretation of what is aggressive tax planning or not. It's just if you meet the hallmark, you report. If you don't meet the hallmark, you don't report. Some of them need an additional test, which we call the main benefit test, which is an additional criterion that is applied and that would require to assess if the main benefit of the scheme is obtaining, that we could see in general circumstances, would be obtaining a tax advantage. So if the main benefit that was sought was obtaining a tax advantage, then this means that the main benefit test will be met. And if the situation of the hallmark is also met, that a report needs to be done. There are families where there is simply no main benefit test. So for those families, as soon as the situation described in the hallmark is met, reports needs to be done without interpretation of what the goal of the taxpayer were, and without assessing if there are other features of aggressive tax planning. So the situations, the exact definition and scope of the situations is very important. On the next slide, we will go together on a description, a hallmark by hallmark description. It's very important to note that the tax authorities, they have not released any guidance. So they did not issue guidances on what the scope of the hallmarks is. Therefore, it's really, there are several possibilities to interpret them. So one needs to be vigilant and one needs to pay attention to the details of those hallmarks to be able to properly report. First family, generic hallmarks. So these are the generic hallmarks. They do not rely on a tax structuring situation. The generic hallmarks, they are trying to capture the existence of a tax aggressive planning based on the terms under which a taxpayer or an intermediary operates, or they try to infer from how a product is commercialized, whether this product is or not an aggressive tax planning product. So for instance, if we go on A1, confidentiality clause, this actually makes sense. The hallmark is trying to detect clauses under which there would be a protection, a confidentiality protection, on how a tax product or how a scheme managed to be tax efficient. So this is a kind of the protection of a trade secret on how the tax product operates. This is what confidentiality clause hallmark is trying to capture. So it's not capturing all confidentiality clauses or that we see in commercial or private equity transaction. It's only the specific type of clauses that want to protect how innovative a scheme is. If we go then, A2 is very simple, self-explanatory, contingent fee. It's where you have an amount of success fee, which is based on the amount or the value of the tax advantage obtained. This is simple. A3 is a hallmark which had the attention of the banking and the insurance world, because this hallmark targets products that are standardized, so products that are very easy to replicate, products that would could be diffused or mass marketed without the needs of a tailor-made or without the need of additional advice. So these are generic hallmarks. It's not expected that they would impact in particular the PE industry. So then we go to the second family, specific hallmarks. Specific hallmarks, the first one is loss buying transaction. It's a very narrowly defined hallmark. The loss buying hallmark would apply in case you have three conditions met, three cumulative conditions met. One is the acquisition of the company, discontinuation of its losses, and then offsetting the results of the acquirer with those losses that have been obtained. So these are situations that are already tackled in Luxembourg case law under the Montel-Cove case law. So this is not something we expect to see a lot. B2, extremely important hallmark, conversion of income. This hallmark could have a very large breadth, and we expect a lot. We need to hear what the position of the tax authorities are on this. Why? Because this hallmark, originally, if we see the BEPS Section 12 of the parliamentary work of the Commission, this hallmark was intending to capture a situation where you would have a conversion of income in management packages. The example is the one of a CEO who, instead of receiving a salary, would receive a dividend from an affiliate that would have been created by his company. So this is simple. Instead of receiving a salary, he would receive dividend because the dividend is subject to taxation at a lower level. And then this hallmark, the interpretation that we can have on this hallmark can be extended, and it can apply to many, many situations in Luxembourg, depending on how it's interpreted. So this one is to follow, clearly. B3, circular transaction. This hallmark, it's really targeting very abnormal arrangements. This is targeting arrangements including circular transaction that result in round trippings of funds. also initially at the inception of the hallmarks, they were targeting situations that were very specific, and we would not expect them to apply, for instance, on a divestment or an exit of private equity, because the term round-tripping of funds is very, very specific. C1 is the most important family of all. C1 is actually, it's tackling the cross-border deductible payments that are made to associated enterprises. So C1 would be lightened up in case you have a cross-border deductible payment to an associated enterprise, which is not taxed on the other end of the payment. And depending on how the exemption of the payment, why the exemption of the payment is obtained, this hallmark would either need to be completed by the main benefit test, or it would not require the main benefit test and entail a systematic reporting. So if there is a cross-border deduction, if there is a cross-border payment entailing a deduction, and on the other of the payment, you have a zero rate jurisdiction, so you have an entity which is exempt, a Jersey LTD, a Bermuda LTD, the main benefit test can still apply. If the payment is simply exempt based on local provision, the main benefit test can still apply. There are other cases which are on the next slide that we will see with C1. There are cases where still cross-border deductible payments which are made and exempt on the other end. If they are exempt or if they are paid to a blacklisted entity, for instance, then immediate reporting needs to be made and no benefit test can save the arrangement. Same thing with C1A. If there is a cross-border deductible payment and the recipient is not resident for tax purposes in a tax jurisdiction, then this will also trigger a systematic reporting. This hallmark is for the moment a green area. There is no guidance, no exact guidance on what is a recipient which is not resident for tax purposes in any jurisdiction. Then we go C2, C3. These are hallmarks without the main benefit test. These are hallmarks that we will not expect to see in the PE industry. They refer to, for instance, structural leasing or to very specific type of transactions, such as stock lending for C3. C4 is one to watch. Different values for asset transfer between two jurisdictions. The scope is it's not exactly clear what this hallmark is targeting. It would target arrangements whereby a payable in a transfer would the value of a transfer would have a significant difference between two member states. So it's also one on which one needs to be vigilant. D hallmarks, it's more for the banking or insurance industry. D hallmarks, the targets, actually they're not targeting aggressive tax planning, they are really targeting tax fraud or tax dissimulation. They aim to discover if arrangements have an effect to undermine CRS or the similar automatic exchange of information text. Or D2, an arrangement involving a non-transparent legal or beneficial ownership chain. This would be very rare, simply because there are many conditions and the hallmark is very narrowly defined. Then we go on transfer pricing, the last family, E1, E2, E3. The most important of these is E3. There are lots of discussion on the exact scope of E3, simply because if you read it literally, an arrangement involving an intragroup transfer of assets, if the projected EBIT after the transfer of the transfer would drop by more than 50%. So it could apply, when strictly read, it could apply to any transfer of assets when the transfer would have a drop in its EBIT following the transfer. So this could be very broad and could impact day-to-day transaction, day-to-day reorganization. But this hallmark comes from the OECD transfer pricing guidelines, because the wording is exactly similar. And we see from the EU parliamentary works that the EU Commission wanted to apply this specific situation where you have a business restructuring that is modifying the allocation of profits, or which is modifying the function, risks, or assets of an entity in very specific cases, which are cases that relate to, for instance, the organization of a principal company, or the diminution of function, the chain of function from a distributor to a fully fledged distributor, for instance. So this hallmark, there are grounds to say that it can only apply in business restructuring situations.
Thank you, Olivier. Really quite tough, these different hallmarks. We know that the mandatory disclosure rules involve intermediaries, and they are for cross-border transaction. So in practice, so Jan, when and who is really responsible to define the intermediaries involved, and respectively also the transaction? How do you see that in practice?
Yeah, thanks, Giuliano. Yes, perhaps. Well, I just briefly take up again the four different persons we likely have involved in DAC6 usually, and four different definitions we see, which Aurélin has already mentioned. So we have quite often the primary intermediary or the promoter of the transaction, the ones who is actually designing, makes available for implementation of the transaction. We have the so-called secondary intermediary or advisor, which knows or could reasonably be expected to know that they have undertaken to provide aid, assistance with respect to designing such a cross-border transaction. Then we have those advisors actually which are like the intermediaries, but are benefiting then from legal privileges. And then at the very end, we have the relevant taxpayer, and as Aurélin has said, it's the relevant taxpayer actually who should only on a subsequent or subsidiary basis basically do the relevant reporting, because the initial reporting should be done by the intermediary. So in practice, I would say first of all, each person needs to determine for himself whether they are intermediaries in a certain context. So the lawyers, the agent, the GP, the service companies, the domiciliation agent in Luxembourg, all of them need to a certain extent determine for themselves whether they are subject to that rule and need to implement basically DAC6 procedures in that context. And then once they have done so, they themselves have that legal obligation to do the relevant reporting to the Luxembourg Tax Administration. And they on their own will have to determine what is actually the relevant transaction and what is actually also for example, the jurisdictions involved in certain transactions for that purposes. What are those relevant jurisdictions involved? I would say it's likely, it's relatively easy on the one hand, because on the one hand, from the jurisdiction involved, all of those member states likely where the relevant taxpayer is resident in that context. So that's quite easily determinable, but it covers as well those member states where they could be affected by the relevant transaction in that context. And that's, of course, much complicated and much more difficult assessment to make in that context. A simple case where it's probably an affection of a member state is if you look at a stock lending transaction, for example, where you have a stock lending transaction between two taxpayers, which are both some relevant taxpayers in that context. They are cross-border because they are two jurisdictions in the EU member states. So these are relevant taxpayers, and we need to do the relevant transaction linked to the reporting in that member state. However, the country affected in addition on that member state is likely the one who issued the shares, basically. So the share issuer, even though it's not a relevant taxpayer in the context, the country which is actually impacted by that stock lending transaction is likely the one of the issuer's jurisdiction as well. That may be included as well. So it's not quite a straightforward analysis in all cases. And theoretically, of course, it would always be the let's say, the intermediary, which has to do the assessment, if they benefit from a legal privilege, they would have to inform the relevant taxpayers or the other intermediaries as well of that obligation, and therefore have to include basically that information as well in their communication with their clients. And the relevant taxpayer who is actually receiving that advice, if they have to do the filing, they have to know that as well in that context. So there's on the one hand the legal obligation, I would say, which each one has to do on its own. On the other hand, from a practical perspective, I would say it falls slightly back to the relevant taxpayer, or the taxpayer more globally speaking, because even though the legal obligation remains with the relevant intermediaries in that context, I think the individual taxpayer, whether it's now the multinational, whether it's the asset manager, whether it's the advisor, they of course want to make sure within their transaction they are actually carrying out that the relevant information is the correct information which is provided, and by the correct intermediaries as well. So they have a very important coordination role to play and monitoring role to play to make sure that whatever is reported by the relevant intermediary is done by the correct intermediary, and likely with the information the client would like to see to be reported as well in that context. So legally speaking, it is quite often the intermediary who has to do the assessment, but in the background you will always have the asset manager, the advisor, who has very important coordination role to play in that context.
Thank you, Jan. Even though we as taxpayer, we try to outsource that to the most of the intermediary, especially we will define the primary intermediary, who is the one who definitely will do the analysis, whether the transaction will be reportable or not according to the mandatory disclosure rules. In that respect, Olivier, assuming you would be the primary intermediary in a private equity and a real estate structure, what do you think will be in practice the hallmark that will most impact, or will impact really this kind of structure? Because we have seen A1s, B2, etc., etc. But what do you believe the primary intermediary will look most on the different hallmarks?
Yeah. The most important hallmark for the PE industry would likely be actually C1, as we just discussed. Julia.
Thank you. We know that the different hallmarks that has been described by you, Olivier, there are most of where this kind of is linked to the main benefit test, and I think there is a definition, but it's not really crystal clear. So, Oliver, how should this main benefit test to be interpreted in the context of a private equity and real estate investment?
Yeah, indeed, and probably can put the slide. Yeah, that's right. At first sight, the main benefit test may appear vague, but we can try to narrow the uncertainty down with some logical considerations. And we also received some high-level guidance from the tax authorities in the meantime. So, as mentioned already by Olivier, so there we have a number of hallmarks. Some of the hallmarks trigger automatic reporting obligations. Other hallmarks trigger reporting obligations only in conjunction with the main benefit test as an additional threshold requirement. And the main benefit test is key to filter out irrelevant reporting. Probably to read out loud how the main benefit test is phrased. The main benefit test is fulfilled if it can be established that the main benefit, or one of the main benefits which, having regard to all relevant facts and circumstances, a person may reasonably expect to derive from an arrangement, is the obtaining of a tax advantage. So that's, this rather vague wording is something which is fairly similar to anti-abuse legislation, such as the general anti-abuse rule or the principal purposes test that has been implemented over the last years. We will come back to that because this might also be helpful to make some, take some reasonable conclusion from that these anti-abuse legislation. So looking at the main benefit test innocently, this test compares the value of the expected tax advantage and compares it to the other benefits that might be derived from an arrangement. If you look to the final report on BEPS Action 12, where the OECD provided guidance on how to design a mandatory disclosure regime, here the OECD concludes that the main benefit test is setting a fairly high threshold for reporting. And they even recommended not to implement the main benefit test and instead to have hallmarks which are fairly clear, clearly describing what the tax authorities are interested to see. Now, next slide. Yeah, so probably before looking at how to analyze the main benefit test in the context of private equity, taking one step back in order to think about how to develop a systematic interpretation of the main benefit test. So probably when thinking about arrangements, so given that today each and every arrangement is subject to a certain tax treatment because everything is subject to taxation, and we always have different options to do things, that means we will always find, say, like an option that gives rise to less beneficial tax outcome. Given that we are thinking about or only considering cross-border arrangements in the context of DAC6, that means in a cross-border context, we even may see situations of double and multiple taxation. So the main benefit test cannot mean whether there is a less favorable option out there. Then the next question, has tax been considered before implementing investments or business activities? And the answer to that question is yes, of course. I mean, tax is probably the single biggest cost position, and asset managers have a fiduciary duty towards their investors to explore opportunities to optimize the tax profile of the investment in accordance with all applicable laws. So therefore, the question whether tax has been considered before or not is not the main benefit test. Then looking at hints that one can find in the hallmarks. So there's hallmark C1, that's the no or low taxation hallmark, meaning this hallmark applies if if a payment is deductible and not taxed or tax exempt at the level of the recipient. So considering that we have like corporate tax rates ranging between 20 and 30%, so that means like apparently a tax benefit of 20 or 30% as such does not mean that the main benefit test is satisfied. And here the main benefit test explicitly states that the very fact that that this hallmark is met does not mean that the main benefit test is met. Then the next hallmark that might give us a hint is the income conversion hallmark. Because that hallmark is only met if the converted income is taxed at a lower level or even exempt from tax. So if we now consider that at investor level, we may have like tax rates ranging between 30 and 45%, and this hallmark is still subject to the main benefit test, even if we have a full exemption. So it means like, yeah, we may think about like fairly significant tax benefits, but if this tax treatment is consistent with the intent of the legislator, then the main benefit test should not be satisfied. And then the last point, which I find interesting to think about, is the link between the main benefit test and anti-abuse legislation, like looking here at the general anti-abuse rule and the principal purposes test. Because while the main benefit test looks at the main benefit or one of the main benefits being a tax advantage, we have the anti-abuse legislation where the GAR looks at the main purpose or one of the main purpose being a tax advantage. And when we look at the principal purposes test in tax treaties, this test looks at the principal purpose or one of the principal purposes of an arrangement being a tax advantage. So considering that human beings are thinking beings, one can consider that the main or the principal purpose is the objective behind an arrangement. On the other hand, the main benefit is the outcome of an arrangement. So therefore, one can say like, yeah, it's the flip side of the same coin. So the purpose must be consistent with the outcome. And therefore, one can think or can make another insertion. If we have like a tax advisor that advises on an investment structure, a taxpayer can expect that the comfort level of the tax advisor should be at least 95% plus, that the proposed arrangement is say like out of reach of anti-abuse legislation. So that means the tax advisor will say like, yeah, I mean, I'm sure that the main purpose or the principal purpose of this arrangement is not the tax advantage. So therefore, it would be rather strange that the same advisor easily concludes that the main benefit of an arrangement was a tax benefit. So that's so much about like, say like some logical insertions. And now like the questions that should be considered when analyzing the main benefit test on the next slide. Yeah, so when analyzing the main benefit test, it makes sense to look at a number of questions that are directly or partially directly linked to the main benefit test, and like additional logical questions that one may ask. So, I mean, the first question is like, is it reasonable to consider that the investment would have been made in the absence of the tax benefit? So that is inspired by the Slovak interpretation of the main benefit test. And I think that is a fairly reasonable question. And now in the context of alternative investments, there we have always a fairly formatted approach, because we always have like the investor, then we have a fund or a pooling vehicle, then we have an investment platform, and then we have the investment. And so that means we then have like say like taxation in the investment jurisdiction of say 20–30%. Then one can optimize that the tax profile of the overall investment in accordance with all applicable laws, but that will always only be a fraction of the return that people will realize. And so it's fairly clear that the investors in a private equity fund make the investment in order to realize ongoing income and benefit from value appreciation at the end, and not to generate tax benefits, even though tax, given that it's such a significant cost, cannot be disregarded. Then the next question, are the commercial and other benefits more significant than the aggregate amount of tax advantages? So that is somehow a hypothetical analysis, because one needs to assume that one realizes profits in the future. Because if you make a profit of 0, tax will also be 0. So one needs to assume, if I make a profit of 100, how would the mechanics of the overall investment structure be? And therefore, likely it will also be again like, yeah, the tax benefit can only be a fraction of the overall commercial income that is realized. The next question would be, are there genuine economic reasons for an investment other than benefiting from a tax advantage? Alternatively, one may ask, is the arrangement artificial? Or could the tax treatment be challenged based on anti-abuse legislation? Because this is say like inspired by the Dutch implementation of the main benefit test, and it's inspired by the general anti-abuse rule, which would not apply if there are genuine economic reasons for an arrangement. And this is something where we have like this limited Luxembourg guidance on the interpretation of the main benefit test, where this is also somehow provided as one of the points to look at. The next question would be, does the arrangement merely rely on the application of tax law as opposed to taking advantage of loopholes in the applicable tax system? Here one needs to think about what happened over the last years. So we had like the implementation of the Anti-Tax Avoidance Directive 1 and 2, providing for a number of like anti-abuse legislations. So and say like all the fields that have where people thought there might be opportunities for abuse have been covered. And so that means like investment or structuring investment today is characterized by compliance with applicable laws and not by creativity. And when an arrangement merely relies on the application of tax law, one can assume that this is consistent with the intent of the legislator. And that is another element that one also can find in the limited Luxembourg guidance on the interpretation of the main benefit test. And then last but not least, is the arrangement known to the tax authorities concerned by the arrangement? Given that DAC6 should provide early information on potentially aggressive tax planning schemes, if the tax authorities know already about these arrangements, apparently it cannot be helpful for them to get additional information under the mandatory disclosure regime. And looking at all these questions, so there should be an overall assessment whether the main benefit test is satisfied or not. And this should then provide certainty to intermediaries and taxpayers whether reporting should be done or not.
But assuming, Oliver, there are, the primary intermediary, and then you have the secondary intermediary, you can have, assuming a Big Four company who is doing the analysis of the hallmark, if it's respected or not, and then assuming they say, okay, that the main benefit test is not respected. What happens if the secondary intermediary who should give the blessing would say that for them, the main benefit test is respected? So there will be then a disagreement. How do you see how it should be settled in practice, and especially what would be the impact for the taxpayer? But because at the end, it is the taxpayer at the end who will suffer about the disagreement between the intermediaries involved in the transaction.
Yeah, that's a very good point. And by the way, it's not only the main benefit test, but also the hallmarks, because there might be different views on that. And we have quite a journey, or we went through a journey over the last 2 years, because different firms started with different positions, now probably moved more and more to a territory of reasonable, but there's still some way to go. And probably to make one example, because we could already assist several clients on managing this. And what I would expect is that normally it should be the primary intermediary also taking care of the DAC6 analysis, because it doesn't make sense that you have say 4 intermediaries in Luxembourg, and as we are speaking only about cross-border arrangement, 4 intermediaries in the other jurisdiction, and every party does the DAC6 analysis on their own, because there will be a cost associated to that. So therefore, it makes sense to have one party in the driver's seat that has all the information, and that is what we did. And so first what we did is having then a call with the other service providers in Luxembourg, and there was the accounting firm, which was, by the way, one of the 4 Big Four firms. There was a big law firm, there was the asset manager. So while then the Big Four firm had their, say, expert team reviewing the analysis, and the same for the law firm. I mean, we just received certain comments, where the analysis should be further developed, but actually we made a fairly good first experiences. So that is quite positive. And also then when thinking about the investment jurisdiction, and we will see that later in the case study. I mean, normally in the investment jurisdiction, we do not see so many things that could give rise to controversy, because typically investments are financed by equity and debt. So there's not so much to consider. But then, say, having different positions between different advisors, obviously the better argument can be helpful in convincing the other party. And again, so far, I'm positive, and I hope that the next months will be helpful to have everybody be on the same page.
I hope so, Oliver, because, as a taxpayer, we definitely, what we want to avoid is over-reporting. We definitely be more on the side for not reporting. Yeah. And Aurélie, how do you see the coordination amongst intermediaries and jurisdiction in this respect, really to avoid this kind of over-reporting?
Yeah, this is the good point, because intermediaries and taxpayers will find themselves in murky waters when it comes to apply the law, and they will be inclined to take a conservative view and make over-reporting just to avoid penalties or because of a poor coordination between them. The point is that over-reporting leads to adverse consequences. First, it entails obviously unnecessary compliance cost for everybody. No need to say that taxpayers won't be happy with over-reporting that could prompt the tax authorities to pick up details of blameless transaction, and plus it increases the risk to report inconsistent information to the tax authorities. Conversely, in case of under-reporting, you may face penalties of up to 250,000 euros. So it will be very critical to avoid under or over-reporting, all the more that it goes against the aim of the law that try to capture genuinely tax-motivated transactions. And in this respect, the expectation of the European Commission when drafting DAC6 was that intermediaries and taxpayers coordinate in order to provide single reports to the tax authorities in a timely manner. This is why the law provides for an exemption from the reporting to intermediaries and taxpayers, as the case may be, if they can prove that the information they have has already been disclosed to the tax authorities. Unfortunately, the law does not provide for a mechanism under which such coordination could be made in practice. And unless the taxpayer takes a strong lead in coordinating the DAC6 exercise, the presence of multiple intermediaries and taxpayers and the uncertainties around the application of the law will likely lead to multiple reporting, over-reporting, or even under-reporting. So the coordination rule, this is the next slide. So the coordination role will consist in putting in place an adequate process that would enable to provide with a clearly defined framework. And one of the main steps of this coordination process would be to determine a person, a party that will be responsible, that would manage the DAC6 issues and perhaps monitor the trigger points. Another important step of the process would be to identify all intermediaries and taxpayers that are involved in the arrangement, so as to clarify the responsibilities for submitting the information to tax authorities. And last but not least, it would also be useful to have a centralized information that could be shared amongst intermediaries and taxpayers, and even a centralized analysis that could be reviewed by taxpayers and intermediaries and on which they could rely. So I would say that the bottom line here is that the more the taxpayer will manage the coordination work, the more it will have a control over the information to be reported to the tax authorities.
Thank you, Aurélin. Yeah, definitely. Yeah, the taxpayer, I think that he has a key role to have in order to avoid this kind of over-reporting. In that respect, Jan, from a legal point of view, how do you see, what approach should private equity and real estate houses take in respect of tax? Do you see in the future that DAC6 would be included in fund documentation, or there will be side letter? I'm more than sure that LPEA houses and real estate houses will have a draft or will have DAC6 policy, internal policy, but do you see that as well to be included in this documentation?
Yeah, good question again. Indeed, I think there's, at the moment, I would say there's still some movement on what is actually included in the fund documentation, because the fund documentation will basically allow the asset manager to obtain certain information. And if you compare it at the moment, for example, if you take the 3 key documents, let's say if we included 3 key documents in the fund formation context vis-a-vis the investors, it's likely the LPA, the limited partnership agreement. You have sort of the subscription form / perhaps as well the side letters, and you have a private placement memorandum to some extent. Currently, the LPAs until DAC6 quite often have sort of tax reporting, tax information clauses already included in those LPAs, but they usually target a different direction. So it usually includes FATCA, CRS, nowadays perhaps as well, ATOZ, where the GP actually requires that information in order to do the correct filing in Luxembourg for the relevant fund in that regard and to avoid any tax leakages, for example, for the relevant SPVs down below or penalties from tax administration. DAC6 is a bit different in that context, I would say, because to some extent you don't want to have too much information from the LP, because if you have too much information, you may be caught that you suddenly have knowledge on certain transactions you wouldn't have otherwise had to disclose or to disclose perhaps to the tax administration. So in the LPA, an obligation or a right for the GP to ask information on the LPs to receive information in relation to DAC6, I would not necessarily think it must be included, but I think I wouldn't as well exclude it, that if it's somehow already included in the LPA, it's not harmful in that regard. What we already see to some extent is in side letters that certain LPs would like to receive information from the GPs in relation to DAC6, and whether they were, for example, communicated as intermediaries or as participants, because they may have filing obligations in their own jurisdiction with regard to portable transactions. Though some of these LPs already request that very proactively to have it included. I can understand that because in some jurisdictions the obligations under DAC6 go further in that context for certain of the LPs, and therefore I think it's just understandable that they will include it in the in sort of that side letter negotiations. PPM, risk factors, tax sections, given there is potentially some sort of a reporting and penalty under Luxembourg law and DAC6, I think it's likely that we'll see some sort of a risk factor and or disclosure on the tax regime going forward, and more in the relevant documentation as well.
Thank you. So I see really we are running out of time. I would keep some time because there are some questions, but I would really like to end with a case study, really that our participants see how should it be, assuming we have a typical private equity structure, what are the steps to be done, to be analyzed, and respectively, what are the hallmarks that could potentially have an impact and where it would be reportable or not. So I think we have a case study. So all of you feel free to add your comments.
So shall I start with the description of the structure and probably the hallmarks, and then we can have other people commenting on that?
Exactly, yes.
So here let's begin with the description of the investment structure. So typical Luxembourg private equity fund. So we have the investors here, we have a Luxembourg fund, the Luxembourg fund being established, say, in the legal form of an SCS. The Luxembourg fund would make investments via Luxembourg investment platform, via Lux Master Co. And Lux Master Co. would make the investment via a local bidco that acquires the operational companies. Now the local bidco is financed by a mix of equity and debt funding in accordance with the law applicable in the investment jurisdiction. Potentially or likely there might be external funding that could be injected at the level of local bidco. Lux Master Co, with regard to the loan granted to local bidco, would finance this loan receivable with a loan granted by the fund. In this respect, Lux Master Co would perform financing activity and has to realize an arm's length remuneration in this respect. Then with regard to the financing of the participation in local bidco, here Lux Master Co would finance the participation by a mixture of equity and debt. Here I'm indicating CBs, convertible bonds. Given that it's the elephant in the room, let's also think that Lux Fund finances Lux Masterco with classes of shares. So that means like, yeah, I mean, select the tax treatment in Luxembourg. The income derived from the participation is tax exempt in accordance with the participation exemption regime. The income from debt funding would be taxable, but overall, Lux Masterco would be subject to tax on the margin, and the repatriation of profits to the Luxembourg fund in the form of interest or conversion of convertible bonds at fair market value or a redemption of a class of shares would be free of Luxembourg withholding tax. So that's the basic private equity structure. In real life, it might be a bit more complex, but I mean, this is pretty a pretty standard investment structure. So like looking to the hallmarks that might be relevant here, I mean, I don't want to like extend, given also the time that or the time constraints that we have, because Olivier already described all of them quite fine. So, but just to go through them, so the confidentiality hallmark should here not be relevant because there's nothing innovative. I mean, you can even read about that in publications, so it's common knowledge. So nothing special, and even a normal confidentiality clause in the service agreement should be unproblematic here. Premium fee hallmark should not play any role, and also the standardized tax product hallmark should not play any role. Sometimes people think like, yeah, if a lawyer starts with a template when drafting an interest-bearing loan, convertible bonds, or fund documentation, that this could satisfy this hallmark, but that would be a misinterpretation. The loss company hallmark doesn't play any role. Now thinking about the converting income scheme hallmark, that is the one that sometimes can give rise to different interpretations or different views. I mean, there could be in the present situation, say like the financing of a participation with convertible bonds, like dividend income is converted into interest payments under the convertible bonds or a redemption of bonds at fair market value. So there one can probably not clearly rule out the satisfaction of this hallmark. And the same thing for the classes of shares. The classes of shares really give rise to significant discussions between different people, and people can really fall in love with details. Overall, I think it does not matter so much whether or not one follows the one school of thought or the other, because this is a hallmark that is subject to the main benefit test. So therefore, I would probably often conclude, like, in my view, this hallmark should not be satisfied, but I cannot rule out that another person would take a different view. So I'm testing systematically the main benefit test. The circular transaction hallmark should also not be relevant here. Then looking to the next slide, the no or low taxation hallmark. I have been saying that the fund would be in the legal form of an SCS. So an SCS is transparent from a Luxembourg tax perspective. So here, say like the common view is that, yeah, then we probably need to look through at investor level, and then we would have a cross-border arrangement. And so like the interest paid by Lux Masterco in regard to the financing activity would then be a deductible payment that is potentially not taxed at the level of the investor. So this hallmark might be satisfied in a given case. But again, this is a hallmark that is subject to the main benefit test, and therefore probably not be absolutely problematic when we now analyze the main benefit test. Because then we would go through the 5 questions, and I mean, I will keep the answers to these questions short, but say like in practice, one would need to develop a robust argumentation, because the main benefit test is really the element that can be helpful to substantiate that something was not reportable, and therefore this and others really need to be robust. So if you can move to the next slide, please. Yeah, so the first question, is it reasonable to consider that the investment would have been made in the absence of the tax benefit? So like here, the investors obviously are looking for generating ongoing income and to benefit from value appreciation at the end of the investment period. The tax has been considered, it's clear, but that tax benefit or the tax benefits that have been realized are ancillary to the main benefit of generating 100 of income. Then are the commercial and other benefits more significant than the aggregate amount of tax advantages? I mean, that's the way taxation works. I mean, having a tax rate ranging between 20 and 30%, and then one optimizes this taxation in the investment jurisdiction, so then this tax benefit will always be just a fraction of the commercial benefit, for sure. Then are there genuine economic reasons for an investment other than benefiting from a tax advantage? I mean, let's assume we have here appropriate substance and the investment is properly managed. One can find many genuine economic reasons for this investment structure. Does the arrangement merely rely on the application of tax law as opposed to taking advantage of loopholes in the applicable tax systems? Here, what we have here, like loans, equity funding, convertible bonds, classes of shares, all of that or the tax treatment of all of these arrangements are governed by explicit tax law, and therefore, select this question can be answered with yes. And last but not least, are the arrangement known to the tax authorities concerned by the arrangement? Yeah, these are common arrangements. It's common knowledge in the market, and therefore it can be assumed that the tax authorities know that all of that exists. Now, having one quick look to the investment jurisdiction, because that would be local BidCo and OpCo. So local BidCo is financed by equity and by a standard interest-bearing loan. So nothing really interesting, and therefore normally one should also conclude in the investment jurisdictions that in a case like this, the main benefit test is not satisfied. I mean, we have one example where one need to be a bit careful. That's Poland, because in Poland, the main benefit test is met if there is an alternative that is less beneficial than the alternative chosen. So there it can be like a registration duty that is saved because of a contribution into share premium instead of share capital. Now, a quick look to a foreign fund example. So if we have a foreign fund, and here the only thing that changed is that we have a foreign fund instead of a Luxembourg fund vehicle. I mean, here the other hallmarks, I mean, we might have a question around income conversion hallmark, but what will always be met in these cases is like the no or low taxation hallmark that should be satisfied. So that means like here we always need to test the main benefit test. However, if we have a genuine substance, meaning an appropriate substance, and everything is properly managed, one should come to the same conclusion as I came before in regard to the Luxembourg fund. Now, like one point of attention is with respect to, say, like Cayman entities involved, because Cayman Islands have been blacklisted in February. So the expectation is that Cayman Islands will be off the blacklist upon the next review of that blacklist, which will take place in October. And if that's the case, then only arrangements that have been implemented from February until, say, October could give rise to automatic reporting obligations, because the blacklisted country hallmark gives rise to automatic reporting obligations and is not subject to the main benefit test. So I guess that would be the two examples that we would like to make.
Thank you, Olivier. Let's go directly to the Q&A, because there are questions that are raised. So I tried to, as we are running out of time, I tried to select the questions which I think is of most of important. There are two questions in relation to class of shares. So the first one was, what about alphabet shares? Are they in the scope for the mandatory disclosure rules? And there is another one with class of shares as well, who is said class of shares put in place between the Lux Fund and Lux Masterco. Therefore, they are not cross-border. Why are they problematic then? Who will take the questions?
I mean, I can address the classes of shares, as I spoke about classes of shares already before. I mean, this thing is like, it's simply not so clear, and different people have different views on that. And therefore, I mean, the income, I would not fight so much against it, because you anyway need to test the main benefit test. So overall it's not so relevant. And even if we have like classes of shares between a Luxembourg master company and a Luxembourg fund, if that fund is then a transparent entity, one could again make the case, okay, it's cross-border. I think there is another argument to say like, yeah, the classes of shares, even in case of a foreign fund, are only a domestic arrangement, as they normally only have a domestic, say like a tax effect, like the withholding tax treatment. And also when we had in 2016 the reporting of tax rulings, the position of the Luxembourg tax authorities was that classes of shares are a domestic arrangement or a domestic ruling. So therefore, there are arguments to make that, yeah, this hallmark should not be satisfied, or it should not even be a cross-border arrangement. But there are people out there that might take a different view, therefore systematically test the main benefit test.
Another question, a company that is liquidated prior to the 1st of July 2020, should any transaction still be reported, and by whom? The liquidator, the shareholder? Who want to take this question?
I can take it, Giuliano. Basically, we need to be assessed if the liquidation as a cross-border is a cross-border arrangement. Then it needs to be assessed again the hallmarks, and then if a reporting needs to be done, we have to check who needs to report. First question, is the liquidation cross-border? We need to verify that the liquidation has cross-border elements. So it would only needs to be tested against the hallmark if, for instance, the shareholder is a foreign shareholder. Assuming that it's the case, which hallmark could be met? There are two hallmarks that could potentially apply, depending more likely on this situation. The first one is E3. So E3, as we've seen, is a hallmark that targets transfer of assets, risk, or functions to a transferee, and the entity which is a transferor would suffer a drop in EBIT. So if the transfer is liquidated, it would per se support a drop in EBIT. So if the liquidation entails the transfer, cross-border transfer of risk, assets, functions, and is done in a business restructuring context, then E3 could be met, and it's not possible to test it against the MBT. Second hallmark that could be met is C1. As we've said, C1 is very important. If, for instance, the Luxembourg company, which is liquidated, has a receivable and the shareholder is a Cayman Limited, the fact that the Luxco is liquidated would transfer this receivable to the Cayman Limited, and then it could entail a cross-border payment, which would be paid to a blacklisted entity. So these would be arrangements that could trigger reporting per se without main benefit test assessed. So it needs to be carefully assessed. And finally, who would have to report? The intermediary who has organized, designed, assisted, or managed the implementation of the liquidation, then should be the one to report. There are always questions to determine if it's a primary or secondary intermediary. If it's a primary intermediary, he would have to report, except if he's exempt. So if he's exempt, he would have to notify the taxpayer or all intermediaries that he knows that a reporting needs to be made.
If I may just jump on this one to make it also a bit more interactive, with regard to the business restructuring hallmark, because this is really important as it triggers automatic reporting obligations not subject to the main benefit test. Here it's really important to understand what is meant by this hallmark. I mean, this hallmark covers business restructurings within the meaning of Chapter 9 of the OECD transfer pricing guidelines. That means multinationals that change their business models in regard to manufacturing, distribution, procurement. That is not a Luxembourg company that makes investments. So the question of a Luxembourg company has two loans. One loan is transferred, and afterwards the EBIT goes more than 50% lower. It does not satisfy this hallmark. And also, like, yeah, we heard over the last 2 years, like some people that said, like, yeah, each liquidation should be reported because obviously after the liquidation, the EBIT goes below 50% of that what it was before, notwithstanding what the amount was before. But that is obviously nonsense and doesn't make any sense.
I agree with Oliver. I think one needs to be careful a bit on that hallmark on the transfer pricing side and really look at the TP guidance from the OECD, what is really called by that rule, and not simply apply it just because we have a liquidation or a transfer of a company in that context.
Same opinion there. Same opinion there.
So there are really a lot of questions to follow. So I cannot go to all the questions. Really sorry. So I will take at least one. And Jan, I think you mentioned a stock lending transaction. Please say what would trigger it for stock lending transaction?
Yeah, I think again one of the more complicated ones of the hallmarks to be met, and where likely a lot of discussions will come up, is B2, so the conversion of income. So sometimes you try to stock lending transaction to convert dividend income and capital gains and things like that. So that's potentially one of the hallmarks which could be met in a stock lending transaction.
Thank you. So I want really to thank you all, the panelists, for your valuable contribution. It was very interesting. We are still receiving a lot of questions. I don't know, Stephane, if we can pull all the questions together. It's quite complicated, but again, really thanks to all, at least to the listener to the webinar. Really thank you for having joined this webinar. I think DAC6 is quite interesting. I see that. And please join all to me to really thanks all the panelists for really the valuable contribution. Thank you.
Thanks a lot, Giuliano. Dear panelists, also big thanks for your involvement and for this great presentation. Wow, what a success. Dear LPEA members and friends, we'll probably see each other again tomorrow for the legal update webinar over the next week with our great program coming up. And for the LPEA members, also don't forget to vote for next week's AGM. Good afternoon, goodbye, and thank you.